You check your balance on a Friday. The direct deposit landed. The number is bigger than it was last year. You got the raise, 3.5%, maybe 4%. You did the thing you were supposed to do. Then you pay rent, you pay the car note, you move something to savings, and by Tuesday, you move it back. And somewhere in the back of your mind, a quiet question forms. Not resentment, just arithmetic. If I'm earning more every year, why does the distance keep growing? Here is the number that answers it. Between 1989 and 2024, according to the Federal Reserve's distributional financial accounts, the wealth held by the top 1% of American households grew from roughly $5 trillion to over $49 trillion. In that same window, the bottom 50% of the country, about 66 million households, went from holding around $700 billion to roughly $4 trillion.
Both went up. That's the part people miss. The gap widened anyway, because the top 1% didn't just gain more, they gained more per dollar they already had. That's not a moral failing on your part. It's a mechanical property of the system you're standing in. By the end of this, you're going to understand something uncomfortable. The rich getting richer isn't one thing. It's about 7 things, stacked, and almost none of them require anyone to cheat. Start with the split that happened in the 1970s. For most of the 20th century, American wages and American productivity moved together. When the country produced more per hour, workers were paid more per hour. From 1948 to 1973, productivity rose about 95%. Hourly compensation for typical workers rose about 91%. They tracked each other almost line for line.
Then they stopped. From 1979 to 2023, productivity rose roughly 80%. Pay for the typical worker rose about 29%. The Economic Policy Institute has been charting that divergence for decades. Economists still argue about the cause: globalization, the decline of union density from about 35% of private sector workers in the 1950s to under 6% today, technological change, corporate governance. What nobody disputes is that the two lines came apart. The output didn't vanish. It went somewhere. It went to capital, to shareholders, to equity holders, to the people who owned the thing, rather than the people who operated it. And that is the first and simplest engine of the whole machine. There are 2 economies in America running at the same time on the same street using the same currency. One pays you for your hours. The other pays you for what you own. The hours economy is capped. There are 24 in a day. You can raise your rate, become a nurse practitioner, a welder, a software engineer, but you cannot escape the ceiling of the clock. The ownership economy has no ceiling at all. Now, put a date on when ordinary Americans got pushed out of the first one and told to fend for themselves in the second. November 6th, 1978. President Jimmy Carter signs the Revenue Act of 1978. Buried inside it is a small provision, Section 401, Paragraph K, intended to clarify the tax treatment of deferred compensation for executives. Nobody at the signing thought it was historic. 2 years later, a benefits consultant in Pennsylvania named Ted Benna was restructuring a bank's retirement plan and read that paragraph differently than Congress had. He realized it could be used to build a salaried employee's entire retirement around their own contributions, with an employer match on top. Benna later said he wasn't sure whether he'd created something good or something dangerous. Here's what it replaced. In 1980, about 38% of private sector workers were covered by a defined benefit pension, a plan where the company owed you a check until you died. By 2020, that number was roughly 15%, and most of those were legacy plans closed to new hires. The risk moved. It used to sit on the corporation's balance sheet. Now, it sits on your kitchen table. And this is the part that matters for the gap. A pension is a promise, but a 401k is a market position. The moment retirement became something you invest in rather than something you're owed, your outcome became dependent on how much surplus you could spare each month and on how early you started. Vanguard's How America Saves report puts the median 401k balance for Americans aged 55 to 64 at somewhere in the range of $87,000. Not the average. The average is inflated by a small number of very large accounts. The median, the middle person, the 50th percentile American approaching retirement,
is around $87,000. That's roughly 3 years of modest spending. It is not a retirement. It is a cushion.
Meanwhile, the same market that produced that $87,000 balance produced something else entirely for people who entered it with capital already in hand. Here's where it gets stranger, because the reason those two outcomes diverged so violently isn't the market's performance. It's a French economist's inequality, written on a chalkboard in 2013, and one arithmetic property of money that almost nobody is taught before the age of 30. In 2013, a French economist named Thomas Piketty published Capital in the 21st Century. It ran over 700 pages. It was full of tax records going back to the 1700s, and it became one of the best-selling economics books in modern history, a book most buyers never finished.
The core of it fits on one line. R is greater than G. The rate of return on capital exceeds the rate of growth of the economy. That's it. When the money you make from owning things, stocks, bonds, real estate, businesses, grows faster than wages and output grow, wealth concentrates. Not because of villainy, because of subtraction. Piketty's estimate was that the historical return on capital ran around 4 to 5% a year, while economic growth over the long run ran closer to 1 to 2%. Economists have spent a decade arguing over his data, his methods, and his conclusions. Matthew Rognally at MIT argued the effect is mostly housing, not capital broadly, but the direction has held. Now apply that to two households. You put $500 a month into a retirement account. Someone else already holds $5 million in index funds and does nothing at all. At 7% a year, that untouched $5 million produces $350,000 in the first year. That's roughly 6 times the US median individual income, generated by no labor, no decisions, no hours. You are running. The capital is sleeping. The capital is still faster. That's not a metaphor. That's what an exponent does. Now add the tax code, because this is where it stops being physics and starts being policy. In the United States, income is not taxed as income. It's taxed by category. If you earn $200,000 from a job, you pay ordinary income rates, up to 37% federal, plus payroll taxes for Social Security and Medicare withheld from every paycheck automatically before you ever see the money. If you earn $200,000 from selling stock you held over a year, the long-term capital gains rate tops out at 20%, plus the 3.8% net investment income tax from the Affordable Care Act. No payroll tax, no withholding. You pay it later, and you choose when by choosing when to sell. Same dollars, roughly half the rate. The difference is whether the money came from your body or your balance sheet. The gap widened deliberately. In 1997, President Bill Clinton signed the Taxpayer Relief Act, cutting the top capital gains rate from 28% to 20%. In 2003, President George W. Bush cut it to 15%, the lowest since the Great Depression. And then there's the piece almost no one outside estate planning has heard of, the step up in basis. Say someone bought Apple stock in 1998 for $10,000. It's now worth $4 million. If they sell, they owe capital gains tax on $3,990,000 of appreciation. If they instead hold it until death and pass it to an heir, the cost basis steps up to the market value on the date of death. The heir can sell the next morning and owe capital gains tax on approximately nothing, roughly $3.99 million in gains, never taxed, not deferred, erased. The Joint Committee on Taxation and the Treasury have both scored this provision in the range of tens of billions of dollars in foregone revenue each year.
Which produces a strategy so well known among wealth advisors, it has a name: buy, borrow, die. You buy appreciating assets. You never sell them, since selling is the taxable event, so you simply don't do it. Instead, you borrow against them, because a loan is not income, and loans are not taxed. You live on the borrowed money. Interest rates on securities-backed lines of credit for large portfolios have often run well below the returns on the underlying assets. Then you die, the basis resets, and the heirs inherit clean. In 2021,
ProPublica published leaked IRS data covering thousands of the wealthiest Americans. Their calculation? Over a 5-year stretch, the 25 richest Americans saw their collective net worth rise about $401 billion, while paying roughly $13.6 billion in federal income taxes. ProPublica called the resulting figure a true tax rate of about 3.4%. A metric that is not how the tax code defines income, and economists disputed the framing loudly. But the underlying mechanism was never in dispute. Unrealized gains are not income, and if you never realize them, they never become taxable. You can't do that with a paycheck. A paycheck is realized the instant it exists. The W-2 is a receipt for a transaction you cannot defer. Then there's the house, and this is where the gap becomes generational.
Homeownership is the primary way middle-class Americans have ever built wealth. In 2022, the Federal Reserve's Survey of Consumer Finances put the median net worth of a homeowner at roughly $400,000. For renters, about $10,400. That's a factor of nearly 40. But entry into that asset was rationed by law for decades. In 1934, the National Housing Act created the Federal Housing Administration. The FHA and the Homeowners Loan Corporation produced residential security maps that graded neighborhoods A through D and outlined the D-grade areas in red. Black neighborhoods were routinely marked D, regardless of income or condition. The FHA's own 1936 underwriting manual warned lenders about inharmonious racial groups. Between 1934 and 1968, federal mortgage programs helped underwrite tens of millions of homes. The overwhelming majority of that lending went to white families.
The Fair Housing Act ended the practice in 1968, but wealth doesn't reset when a law changes. A family that bought in 1955 for $12,000 in a neighborhood now worth $700,000 didn't just get a house, they got a down payment for their children, tuition, a business loan collateral, a cushion against one bad year. As of 2022, the Fed measured median white household wealth at roughly $285,000, and median black household wealth at roughly $44,900, nearly a 6-to-1 ratio in a country that outlawed the mechanism 57 years ago. Inheritance is not just money. Inheritance is not having to start at zero. So, 2 economies, a broken pay curve, an exponent, a 2-tiered tax code, and a housing ladder with the bottom rungs removed for entire populations.
That's 5 engines. It should be enough to explain the whole thing. Except it isn't, because there's a final layer, the one that operates not on your balance sheet, but on your prices, your risk, your access, and your attention. And in March of 2020, the Federal Reserve demonstrated it in public, in 11 days, in front of everyone. March 2020. On March 3rd, the Federal Reserve cut rates by 0.5 point in an emergency move. On March 15, a Sunday, it cut again to near zero and announced $700 billion in asset purchases. Over the following weeks, the Fed's balance sheet expanded from roughly $4.2 trillion to over $7 trillion. By 2022, it exceeded $8.9 trillion. The stated purpose was to prevent a credit freeze. In that, it worked. Corporate bond markets that had seized up in mid-March were functioning again by April.
But cheap money doesn't stay where you point it. It bids up the price of everything that can be owned. The S&P 500 bottomed on March 23, 2020 at 2,237. Within 5 months, it had recovered its entire loss. Within 18 months, it was up more than 100% from that low. U.S. home prices, measured by the Case-Shiller Index, rose roughly 45% between early 2020 and mid-2022. Now, hold both facts at once. During the same period, over 20 million Americans lost their jobs in April 2020 alone, the highest single-month unemployment figure since the Bureau of Labor Statistics began collecting the data in 1948. The Fed's own numbers showed the top 1% of households adding roughly $6.5 trillion in wealth in 2020 and 2021. Not because they worked harder that year, because they owned the assets that the rescue repriced. This is the part that goes unsaid. When a central bank stabilizes an economy by supporting asset prices, it necessarily helps asset holders first. Ben Bernanke defended a version of this in 2010, the portfolio balance channel. The idea that lifting asset prices creates spending and hiring that reaches everyone eventually. It's a real mechanism. It also arrives in a specific order. Owners first, wage earners later. If you owned nothing in March 2020, the rescue was something that happened near you. And underneath all of it runs the quietest engine of the seven. It is expensive to be poor. Not metaphorically, line item expensive. If you can't hold a minimum balance, you pay overdraft fees. American banks collected roughly $12 billion in overdraft and NSF fees in 2019, a figure the CFPB has tracked closely. If you can't get approved for a prime auto loan, you pay subprime rates, often 15% to 21% APR on a depreciating asset you need in order to keep the job. If you can't cover a $400 emergency, and the Fed's own survey has consistently found about a third of American adults cannot, you use credit at 24%, or a payday product at an APR in the triple digits. If you can't afford a security deposit, you rent weekly at a higher effective monthly rate. If you can't buy in bulk, you pay more per ounce. If you can't afford the dentist in March, you pay for the extraction in September. Economists call it the poverty premium. It means the same life costs more at the bottom, and it inverts perfectly at the top. Large portfolios get lower fund fees, large borrowers get lower interest rates. A private bank will lend against a $20 million portfolio at a rate a wage earner will never be offered on anything. Under SEC rules, entire categories of investments, private equity, most hedge funds, pre-IPO shares, are restricted to accredited investors, generally requiring $200,000 in annual income or $1 million in net worth, excluding your home. That rule exists to protect people from risk they can't absorb. That's a genuine rationale. It also means the fastest compounding corners of the market are legally gated by how much money you already have. Money is a discount code. The more you have, the less everything costs. So it isn't one thing. It's productivity splitting from pay in 1973. It's the 401k inheriting a risk that used to belong to a corporation. It's R greater than G. It's a tax code that charges your labor more than someone else's ownership. It's a housing ladder that was closed by federal policy until 1968 and never reopened backward. It's a central bank whose stabilizing tools arrive at asset prices first. It's the arithmetic of scale, where the same transaction costs less for the person who needs the discount least. 7 mechanisms. No conspiracy required. Most of them were built for reasons that seemed sound at the time, by people who were solving a different problem.
That's what makes it durable. A conspiracy can be exposed. A system just runs. And here is the last thing, the part that has nothing to do with policy. You were taught to think about money in units of income. How much do you make? What's your salary? Did you get the raise? Every question anyone has ever asked you about your finances was a question about the flow. The people pulling away were taught to think in units of ownership, not what comes in, what it's attached to. Those are 2 different languages describing the same currency, and the country you live in is fluent in the second one and teaches the first. So when you look at that balance on a Friday and the arithmetic doesn't feel right, understand what you're actually sensing. It isn't that you're behind. It's that you've been measuring in a unit the system stopped using in 1973.